government budget and economy. This is our next topic. You have learned something about fiscal policy in our one of the last topics, which relates to taxation and expenditure policy of the government. Government budget is a further explanation of the same. Before we talk about how government budget can be used to implement policy decisions in the economy, let us first see what the government budget is. Broadly, government budget is a statement showing estimated receipts and expenditure of the government expected to take place during the year. So, if we talk about the budget of the year 15-16, normally the year is from 1st April to 31st March, then government budget for the year 15-16 will give you estimated receipts and estimated expenditure of the government during this year. When we talk of budget receipts, these are nothing but the funds expected to be raised by government during the year. A broad outline of the government budget is given here. The figures in this budget relate to the year 2012-13. This is broad rounded off to 1,000 crores. You see that it has three parts: receipts, expenditure and deficits. Budget actually ends here. In receipts, we have two types of main receipts: revenue receipts and capital receipts. Similarly, in expenditure, we have two types of expenditures: revenue expenditure and capital expenditure. So, what is common between the two is revenue and capital. We will just see the meaning of these two, revenue and capital. The main components of revenue receipts. What are the revenue receipts? We will see just now: tax revenue, receipts from tax and non-tax. In capital receipts, we have loans recovered. Remember, not loans given, but loans recovered. Other receipts, mainly PSU, public sector undertaking disinvestment, and borrowings and other liabilities. Similarly, we have revenue expenditure and capital expenditure. Before we come to the deficits, let us first see what do we mean by revenue receipts. What are revenue receipts? Those who have studied accounts will be able to understand this very easily. In accounts paper, you have mainly two types of accounts: trading account and the balance sheet. In trading account is more or less similar to the revenue receipts and revenue expenditure of the government, while the balance sheet is more or less revenue expenditure and capital expenditure. What are the revenue receipts? They are broadly defined as receipts which neither create any liability nor lead to reduction in assets. For example, tax received from people by the government. It is a revenue receipt in the sense government is not under any liability to return the tax, and at the same time no assets of the government are reduced. So, all such receipts, whether from tax or from non-tax. Non-tax means, for example, interest received by the government or other transfer payments received by the government, they are all included in the non-tax revenue. What is a tax? In fact, we have learned about this earlier in national income topic. It is a legally compulsory payment made to the government. And you have also learned that a tax is divided into two parts: direct taxes and indirect taxes. Let us just repeat, what do direct taxes mean? Direct taxes are those taxes in whose case the liability to pay and incidence both lie on the same person. For example, income tax. If I pay income tax to the government, it is my liability and the burden of this tax is on me only. Incidence means burden. So, there are direct taxes, then there are indirect taxes. In case of indirect taxes, liability to pay and incidence are on different persons. For example, sales tax, you are familiar with this tax. Who is liable to pay this tax to the government? The producer is liable to pay this tax. But from whose pocket this tax comes? This tax comes from the pockets of the buyers, the consumers. So, liability of this tax lies on one person, that is producer, while burden of this tax, incidence of this tax lies on other person. You must be hearing a lot about a new tax proposed to be raised, proposed to be levied throughout the country. A lot of discussions are going on, lot of controversies are going on. Goods and services tax. GST. Even GST, if imposed, will be an indirect tax on the people. As far as non-tax revenue is concerned, all receipts of the government, all revenue receipts of the government other than taxes, for example, interest. If government has given a loan to somebody and government receives interest in return for the same, that is a non-tax revenue. Dividends. Government owns shares of the companies and in return receives dividend, that is a non-tax revenue. Profits of government enterprises, public sector enterprises, they are also part of a non-tax revenue. And I told you earlier, transfer payments from other countries, we call them external grants. External means from outside the country. External grants, all these are examples. So broadly, any receipt of the government, any revenue receipt of the government other than tax revenue is called non-tax revenue. Now we come to capital receipts. The meaning of capital receipts is just the opposite of revenue receipts. We have learnt revenue receipts do not create any liability or do not lead to reduction in assets. We just remove the word not. If the receipts create liability or lead to reduction in assets, then these are called capital receipts. For example, loans taken, they create liability. Recovery of loans, they reduce asset. The loan given to the loan given by the government was a asset earlier. If government recovers this loan, government's assets are reduced. Then there is a term called disinvestment. I don't know whether you are familiar with this or not. Disinvestment simply means selling of the shares held by government to the private people. That is disinvestment. So when government sells its shares, its assets are reduced, and all receipts from this is called capital receipts. So these were some of the capital receipts. Now we come to budgeted expenditure. Once again, there are two types of expenditure: revenue expenditure and capital expenditure. Revenue expenditure is the expenditure which does not lead to any creation of assets.